What do a dead CEO with all the passwords, a stable coin that was never stable, and a crypto exchange run like a personal piggy bank all have in common? They stole over $50 billion, and they're the reason everything about crypto in Europe just changed forever. In December 2024, the European Union launched the most comprehensive crypto regulation in history. It's called MiCA, the Markets in Crypto Assets Regulation. And if you work in financial crime compliance or fraud prevention, your job just fundamentally changed. Let me show you exactly why. To understand why MyCA exists, you need to understand what happened without it. Between 2014 and 2022, the crypto industry was the Wild West of finance. No unified rules, no licensing, no market abuse enforcement, and the fraudsters knew it. Let's start with Quadriga CX, Canada's largest crypto exchange, over 76,000 customers, more than $215 million in deposits, and one man held every single key. Gerald Cotton, the CEO, created fake accounts under aliases. He credited himself with fictitious cryptocurrency that didn't exist. Then he traded those fake balances against real customer orders. When his trades lost money, he used new deposits to cover the losses. Classic Ponzi structure hidden behind blockchain technology. Then, in December 2018, Cotton died in India. The private keys to the cold storage wallets died with him. $250 million in cryptocurrency became permanently inaccessible. The Ontario Securities Commission later concluded it was, quote, an old-fashioned fraud wrapped in modern technology. Here's what MiCA addresses. Quadriga CX had no compliance function, no internal audit, no governance structure beyond Cotton himself. One person controlled everything and nobody was watching. That specific failure is now illegal under MiCA. Now let's talk about Terra Luna. Do Quan promise to build what Bitcoin couldn't? A stable coin that would maintain a dollar peg through an algorithm. At its peak, the ecosystem reached a market capitalization of $40 billion. $40 billion. But here's what Quan never told anyone. The system had a fatal design flaw, a built-in throttle on redemptions. When users wanted to exchange UST for Luna, transaction fees would spike dramatically if volumes exceeded roughly $20 million. For a stablecoin with a multi-billion dollar market cap, this was catastrophic. The system could handle only a tiny fraction of what it promised. When UST lost its peg in May 2021, the algorithm failed. Quan's response? He made a secret oral agreement with a high-frequency trading firm to manipulate the price by purchasing tens of millions of dollars in UST. Not because they believed in it, but because Quan promised to accelerate their token delivery from an existing deal. Pure market manipulation, completely hidden from investors. It gets worse. Quan's Mirror protocol was marketed as fully decentralized. He publicly claimed token holders governed everything through voting, with no special privileges for Terraform. This was a lie. Internally, Terraform maintained control of governance tokens and secretly kept operator keys Quan publicly denied owning. An internal message stated plainly, Mirror isn't decentralized. In January 2025, Do Kwon pleaded guilty to fraud. He was sentenced to 15 years in federal prison. But by then, $40 billion had evaporated. And here's the key for compliance professionals. Under MiCA's market abuse rules, everything Quan did would have been detectable and prosecutable from day one. Then came FTX. Sam Bankman-Fried built what appeared to be a legitimate empire, an exchange called FTX, a trading firm called Alameda Research, supposedly separate. In theory, FTX accepted customer deposits for trading, and Alameda made its own bets with its own capital. In practice, over $8 billion in customer deposits went directly to Alameda. They used customer funds for margin trading and risky bets. When Alameda's trades lost money, the shortfall was covered with new customer deposits. Customers had absolutely no idea their money was funding a hedge fund's gambling losses. In November 2023, Bankman-Fried was convicted of wire fraud and conspiracy to commit money laundering. In 2024, he received 25 years in federal prison. FTX had no meaningful custody controls, no segregation of customer assets, and no audit trails anyone could verify. Under MiCA, these specific failures are now licensing requirements. But these weren't the only catastrophes. BitConnect promised users 1% daily returns through a trading bot. There was no actual trading. New investor deposits paid returns to older investors. Classic Ponzi. At its peak, BitConnect's market cap hit $3.4 billion, promoted by influencers who never disclosed they were being paid. When BitConnect shut down in January 2018, the token crashed 92% in 24 hours, from $463 to below $2. 2.6 billion in market cap evaporated in a single day. Thousands of retail investors lost their life savings. And then there's OneCoin. Ruja Ignatova, the crypto queen, promised to build a Bitcoin competitor. She held massive conferences at venues like Wembley Arena with 20,000 attendees. The problem? OneCoin had no blockchain, no mining process, no real decentralization, just a centralized database and $4 billion in investor losses. In October 2017, as law enforcement closed in, Ignatova boarded a flight to Athens and vanished. The FBI added her to its 10 most wanted list. A $5 million reward has been offered. She remains a fugitive. Her proceeds laundered into Dubai real estate, including a $2.5 million penthouse overlooking Palm Jumeirah. By 2022, the situation was untenable. Quadriga CX 169 million, Terra 40 billion, FTX 8 billion, BitConnect 2.4 billion, OneCoin 4 billion. Fragmented oversight across 27 EU member states. No market abuse rules, no AML baseline, zero consumer protection. The European Parliament responded. In April 2023, they approved MiCA. On May 31st, 2023, it was formally adopted. June 30th, 2023, it entered into force. And as of December 30th, 2024, full application began. Three objectives: legal certainty for crypto markets, consumer and investor protection from fraud, and market integrity as crypto scales globally. MyCA is built on four pillars that directly address every failure we just discussed. For financial crime professionals, understanding these pillars isn't optional. They define your new operating environment. Let me walk you through each one. Pillar 1: Authorization and Governance. Before MyCA, crypto exchanges and wallet providers could operate with minimal oversight. Under MiCA, any entity providing crypto asset services must be authorized by a national competent authority in an EU member state. One license, one rule book, no jurisdictional arbitrage. To get authorized, firms must demonstrate legal entity status in the EU, real management making real decisions in the EU, robust governance with documented risk management policies, and detailed IT security procedures. Remember Quadriga CX with one person controlling everything? That specific structure is now prohibited. MyCA also mandates minimum capital. Exchange operations require 150,000 euros, custody services 125,000, order execution and advice 50,000, plus ongoing prudential safeguards including insurance or bank guarantees for client asset protection. No more running an exchange on a laptop with no reserves. Pillar 2: AML and CFT integration. MiCA integrates anti-money laundering obligations directly into the framework. Article 62 explicitly requires CASPs to maintain internal control mechanisms to assess and manage money laundering risks as a condition of authorization, not a suggestion, a licensing requirement. All CASPs must now implement customer due diligence, identify and verify natural persons and legal entities, identify ultimate beneficial owners, screen for politically exposed persons and sanctions lists, apply risk-based approach with higher scrutiny for higher risk customers. This applies to every crypto transaction, not just large ones. Transaction monitoring gets crypto-specific under MyCA. You need real-time detection of suspicious patterns, behavioral analysis for unusual velocity and structuring, on-chain analysis for wallet tracing, mixer detection, and darknet-linked addresses. If funds touched a mixer or came from a sanctioned address, your systems need to flag it. When you identify suspicious activity, you report to national financial intelligence units. Clear escalation procedures from frontline staff to compliance officer to money laundering reporting officer to the FIU. All CDD and transaction records must be retained for at least 5 years, made available to authorities on request, full audit trail for every compliance decision. Pillar 3: Market abuse and insider dealing. This is what would have stopped Terra. Title 6 of MiCA establishes rules to deter and sanction market abuse. Three core prohibitions: insider dealing, unlawful disclosure of inside information, and market manipulation. Everything Do Kwon did falls into these categories. MyCA specifically targets pump and dump schemes, spoofing with fake orders, layering to create false volume impressions, wash trading, and even MEV extraction like sandwich attacks. If you're building order monitoring systems, these are your detection scenarios. CASPs must now monitor for and report market abuse the same way traditional securities exchanges do. Insider dealing rules mean trading on material, non public information is now prosecutable. Knowledge of protocol upgrades, token unlocks, or issuer financial distress before public announcement. If you trade on it, you're breaking EU law. Remember when Kwon secretly coordinated with a trading firm to prop up the UST peg? That would trigger immediate investigation under MiCA. Pillar 4: Token categories and stability. MiCA distinguishes crypto assets into categories with different requirements. For financial crime professionals, the key distinction is between assets with systemic financial stability implications and everything else. This is where Terra would have been caught. Asset reference tokens and e-money tokens face the strictest requirements. Issuer authorization, white paper liability for incomplete or misleading information, reserve assets fully covering liabilities, minimum capital of 350,000 euros plus prudential ratios, recovery plans for reserve shortfalls. If UST had been issued under MyCA, the white paper would have had to disclose the redemption throttle. Here's the key innovation. Under MyCA, issuers are liable for incomplete, unclear, or misleading information in their white papers. Do Kwon publicly claimed Terra's algorithmic mechanism worked when he knew it had a fatal flaw. That specific lie would have created personal legal liability. The disclosure requirements make it much harder to hide systemic risks. Let's talk timeline. MyCA was adopted May 2023, but implementation was phased. June 2024, stablecoin rules became applicable. December 2024, which is now, full CASP licensing rules are in force. You have until July 1st, 2026 under the grandfathering provision, but some member states have shortened this. If you were registered under national regimes before December 30th, 2024, you can continue operating under national law until July 1st, 2026, or until you're granted or refused MyCA authorization, whichever comes first. But this is not a free pass. Applications are being processed now. The Netherlands, Germany, and other EU hubs are already authorizing CASPs. Now, here's what this means for you specifically. If you work in financial crime, compliance, or fraud prevention at a crypto firm, your mandate just expanded dramatically. Before December 2024, most crypto firms had minimal compliance infrastructure. AML was a checkbox. Market abuse monitoring was virtually non existent. That era is over. Your transaction monitoring now needs crypto-specific scenarios: mixer detection, chain hopping identification, darknet tracing, sanctioned address screening, behavioral anomalies like unusual velocity and structuring. If you're not building these capabilities now, you won't meet authorization requirements. You also need to build a market abuse monitoring function that probably didn't exist before. Order pattern analysis for spoofing and layering, insider trading detection around announcements, price manipulation flagging, MEV extraction monitoring. These are new compliance responsibilities that come directly from MyCA Title 6. Governance responsibilities expand too. Fit and proper certification for all managers. Internal control effectiveness documentation. Annual attestation to NCAs that your AML controls are effective, and market abuse monitoring is functioning. Work with internal audit to test control design. This isn't optional, it's a licensing condition. Here's the strategic reality. MiCA creates significant competitive dynamics. Firms that implement robust controls before July 2026 will be licensed first and capture market share. Traditional finance players already have regulatory experience and are obtaining CASP licenses now. The fixed cost of compliance is substantial, but it's amortized across larger volumes. Expect market consolidation. Many startups will struggle to justify the compliance investment. Some will exit the EU market entirely. Larger CASPs have scale advantages. Traditional banks entering crypto can leverage existing infrastructure. If you're at a smaller firm, The strategic question is whether to build, partner, or exit. Let me give you a concrete mapping. Quadriga CX's single person control, solved by mandatory fit and proper standards and organizational segregation. Terra's market manipulation, solved by Title VI insider dealing and manipulation prohibitions. FTX's custody abuse, solved by mandatory custody controls and asset segregation rules. BitConnect's misleading marketing, solved by white paper liability and fair marketing requirements. So, what do you do now? If your firm isn't already in the authorization process, begin immediately. Expect 3 to 6 months for NCA review. By Q1 2025, first wave of authorizations will be complete. Early movers have market advantage. By late 2025, the new anti-money laundering authority will be fully operational. July 1st, 2026 is the hard deadline. Any CASP not authorized by then must cease EU operations. For practical implementation, break it into 3 areas. First, authorization and governance. Ensure fit and proper standards, robust governance, adequate capital. Second, AML and CFT integration. Build crypto-specific transaction monitoring. Implement KYC, file SARs to FIUs. Third, market abuse. Monitor for suspicious order patterns, price manipulation, insider dealing. Report to NCAs. MiCA represents a watershed moment. It transforms digital asset services from a regulatory void into a structured market with standardized rules, mandatory licensing, integrated AML requirements, and explicit market abuse protections. The frauds that preceded it are cautionary tales of what happens without oversight. MiCA isn't perfect. There are gaps around decentralized finance and peer-to-peer trading, but it represents a fundamental shift toward treating crypto as a regulated financial market rather than a regulatory afterthought. For your compliance program, the message is clear. MiCA is not optional, it's the new baseline. Firms that master MiCA early will gain competitive advantage, build compliance infrastructure that's difficult to replicate, attract institutional customers who demand regulatory certainty, and reduce legal risk. Firms that delay will face compressed timelines, longer NCA review queues, and potential license denial. Position your institution to be among the first and most trusted MiCA authorized operators in the EU market. The window for early advantage is closing. If this breakdown was useful, subscribe for more deep dives on financial crime and compliance. Drop a comment with what regulation you want me to cover next, and I'll see you in the next one.